LLCs are probably the most popular structure right now. Of course, you have sole proprietorships, which are basically, just somebody going out and starting a business. No paperwork really to do that. No legal documents or registration with the Secretary of State. It's the cheapest, easiest way to kind of go out and start. And then partnerships are the second option. Basically those, if you have more than one person, you always have to have more than one person have a partnership. And then, so you have shared management duties, and each general partner is personally liable for the partnership obligations. You can have multiple general partners, or you can have one general partner and then limited partners, which is makes it a limited partnership. And a lot of times, limited partnerships are used for like single construction projects. You may have the one general partner and then some investors that come in as limited partners, who they basically, all they have on the line is what they have invested in that project. Whereas a general partner, if something happens and they get a lawsuit filed against them, they have what is invested in that project and their own personal assets are subject to that lawsuit. So being a general partner, there's more responsibility. You have a little bit more on the line. And every partnership must have at least one general partner. We have corporations. Of course, everybody thinks of corporations as, the big corporations, Coke and those kind of corporations, where it's, multiple investors, and there's really no limit on who can invest in a corporation, and corporations will have a perpetual life, so it doesn't matter if the original owner passes away. It's set up to go on forever, basically, and has a board of directors. Board of directors hires, the CEO, CFO, and those sort of things. And the corporation pays the corporate income tax. It's the only entity that pays tax separately. All the other entities, the tax actually gets paid, the income tax actually gets paid by the individual owners. The corporation is liable for its own debts. So, the debts are, in other entities, the debts can, like in a general partnership, the general partners are liable for the debts of the company. So if the corporate or the partnership can't pay it, the partners will have to pay those debts. With a corporation, if the corporation can't pay it, they can't go down to any of the shareholders and say, we need you to pay these debts off. And the stockholders are only liable for what they have invested in the company. So kind of along the same lines, if the company's ever sued or anything like that, they can't come to the investors, the stockholders, and try to get money from them. Everything cuts off at the corporate level. And stockholders end up paying tax on the dividends that are distributed out to them. So the corporation pays tax, corporate tax, and then if they have money left over, they may issue a dividend to the shareholders, and then the shareholders are taxed on that dividend at their individual income tax rates, which that's, if you ever hear of the double taxation, that's what they're talking about, because the corporation pays tax on the income, and then when it's distributed out to the individuals, they pay tax as well. That's the big drawback of being organized as a C Corp, is you have the two layers of tax, which is a disadvantage. C corporations, they do have the ability, increased ability to raise capital. They can issue more stock to help raise capital. It's also can be easier to borrow money, and it's also easier to transfer stock to other individuals, easier to sell it or gift it to later generations. And like I said before, the management fiduciary responsibilities are vested in the board of directors. So it kind of all falls on them. They're in charge of hiring the people that are going to run the day-to-day operations. And then standardized statutory method of organization, management and finance. So all that's kind of laid out. The board of directors kind of decides the direction they want to go, how they want to obtain financing and that sort of thing. And then the CFO and CEO kind of execute the plan. So next we'll go to S corporations. This is another very common entity structure. There's the difference between the S corporation and the C corporation. The main difference is there's no corporate tax paid by the S corporation. All of the profit or loss from the business just gets reported by the individuals on their individual income tax returns. So the corporation doesn't pay any income tax. It all passes through. So you only have one layer of tax. You don't have two like you do with the C Corp. But it comes with restrictions. You must be a domestic entity with only one class of stock. So all the stockholders have to be treated equally in an S corporation. You can't have anybody that gets money before the other shareholders. Everybody has to be treated equally. There's a limit. You can only have 75 shareholders, and there's limits on the types of shareholders you can have. Some trusts can own S Corp stock, but mainly it is just regular individuals that can own it. So there's advantages on the tax side, but there's also limitations that you have. And then there's also rules, the passive income from things like dividends, interest, royalties, rents, annuities, and securities transactions cannot exceed 20% of revenues. So basically they want the S corporations to be active businesses that are generating a profit, and not just something set up for somebody to keep their investment accounts and stuff in, run those through. Limited liability companies, these right now are probably the most common entity structure we see. Advantages over both partnerships and close corporations. they have the limited liability, which S corporations have limited liability. You can only you're only liable for what you have invested in an S corporation, and the same with an LLC. And so that's why a lot of people like the limited liability companies. You still get that same limited liability, but it's a lot more flexible than an S-corp. You don't have the limitations on the number of investors, and you can treat people differently and investors differently. You don't have to, with an S corporation, if you just make a distribution, everybody has to get their same share of a distribution. With an LLC, if one guy owns 80% and he pretty much runs it, he can say, well, I want to take a distribution, but I don't want to give the other people a distribution. So there's a lot more flexibility with what you can do. And with an LLC, most of these are taxed as partnerships. That's the default. If you don't choose to be taxed as an S corporation, you're taxed as a partnership. And it says it can be expensive to set up and administer, but in my experience, they're not very expensive. It kind of depends on how complex you want to make it. If it's just a few people, you can have an attorney drop an agreement fairly inexpensively, and I think it's $100 or $150 to do the initial setup with the Secretary of State, and then it's $25 a year fee with the Secretary of State to continue that. So not very expensive. Now, if you have a lot of members and you want to get real complex on the organization documents and everything, then I'm sure you can spend as much as you want with an attorney. I've seen LLCs that they have 50, 60 partners, and it's basically just the same as if it was a partnership or an S corporation. It's treated just the same for tax purposes, and for legal purposes they're very similar. They don't put those things in an operating agreement, and it's kind of a, hey, this is what we're going to do, and they think everybody's on board, and later people start arguing, and but yeah, you can. I've seen several where they have about half of the people work actually in the business, and then they bring in outside investors who put in the money, and the other members that work in the business, they don't have to contribute any money up front because they're the ones doing the work. That's kind of what they're adding to the business. So if you're investing in an LLC, you really have to understand what's going on, and if you're putting in money, maybe not everybody else is, and understand how they're going to do distributions and that sort of thing. Try to make sure that that it's set out how they're going to do distributions, and it's not just the majority owner deciding on a whim when money will be distributed. Because you have that flexibility, people aren't always sure when they may be getting their investment returned to them. And this, like an S-corp and a partnership, it can be taxed as a partnership or as an S-corp. So all the income just flows through and gets reported on your income tax return individually. And that's another issue to watch for with all the flow-through entities, the partnerships, SCorps, and LLCs. That income gets reported to you, and you have to pay tax on that, whether you get any money out of the business or not. So, they may make, $50,000, and you have to report your share of that on your income tax return. But if they don't make a distribution, you're not getting any money out of the entity, the business, to pay that tax. So if it's a single member LLC, it's what we call a disregarded entity. So for tax purposes, they basically look at it like a sole proprietor. They don't treat it any different. You just report it on your individual tax return, and you don't have to file a partnership return or an SCorp return or anything like that. So most people nowadays, you don't see very many true sole proprietorships. Almost everybody sets up an LLC, and it's a single member LLC, because they still offers the limited liability, but everything else is the same as a sole proprietorship. So next, joint ventures. You don't see these very often, at least I don't. They're generally created around a single activity or project. Each joint venture partner contributes a proportionate share of resources and receives a proportionate share of profits. Similar to partnership, in that liability may be unlimited. So, just like if you're a general partner, you're liable for the debts of that joint venture. Even if the joint venture doesn't have the assets to pay off all the debts, then they'll come to you and say, you're liable for these. We need to get some money. It's usually there's usually a joint venture agreement, contract, the incorporation of separate joint venture business entity, which would be a corporate joint venture, or the establishment of a partnership that runs the joint venture. So there's several ways you can do that, but basically that's usually where you have maybe two businesses that are set up as partnerships or S corporations or LLCs that decide they're going to come together and work on a project, and usually they're large projects. Otherwise, it wouldn't necessitate actually going through the trouble of setting up a joint venture. But that way they can set up something, have a contract, everybody have an understanding of how everything's going to work. So I'm not sure as far as bidding on projects. I think the others are just probably seen as more stable, and it's easier if you need to bring in somebody else to help you out. You can do that. With a sole proprietorship, you can't really bring in more investors. As far as getting loans, I'm not sure what the reason is, but I just don't have enough experience with that side of it, issuing loans and.
Most people, Victoria, where it says unlimited personal liability on that, I think people look at it as if they incorporate, it limits their liability, so maybe they're a smarter business person.
Yeah, I don't know.
I don't know.
But and another thing, Yeah, if you're a sole proprietor and you're going to get a loan, they have to look at all your personal finances to decide whether they can give you that loan or not. Where if you're an S corporation or a partnership, you're going to give them the financial statements for your business, and they'll look at that, and it's less complex, I think, to look at that than look at an individual's whole personal financial situation. A couple things I wanted to kind of touch on. Probably most of you are already set up have your business structure set up already, but you can change. If you're an LLC, you can elect to change and be taxed as a different. If you're taxed as a partnership, you can change and elect to be taxed as an S corporation, and if you meet the qualifications and all that. But or if you decide to set up a new business venture, always talk to an attorney or a CPA. There's a lot of different things that can come into play with the differences in the entity structures, and like debt is one thing that's a major difference between partnerships and S corporations. How the debt is treated in an S corporation, to get the advantage of having the debt, you have to personally loan the business the money. If you take out just a loan, even if you co-sign on the loan individually, then you don't get the advantage of that being taken into account when they're allowing losses that you can take. Whereas in a partnership, as long as you guarantee that loan through the business, you can get that advantage of that debt being considered when you consider for taxes what losses you can claim on your tax return. So there's lots of other things like that that are affected by the entity structure you choose. So talk to your attorneys and CPAs and bankers, and just be open with them and tell them exactly what you want to do and what your goals are, and then that way they can be sure and give you the advice that you need and know that you're on the same page. So, were there any other questions about the business structure? No? All right, well, that's all I had on that. So should we take a break right now? All right. Take a break and... Oh, yeah. If you're a sole proprietor and you're going to get a loan, they have to look at all your personal finances to decide whether they can give you that loan or not. Where if you're an S corporation or a partnership, you're going to give them the financial statements for your business, and they'll look at that, and it's less complex, I think, to look at that than look at an individual's whole personal financial situation. A couple things I wanted to kind of touch on. Probably most of you are already set up have your business structure set up already, but you can change. If you're an LLC, you can elect to change and be taxed as a different. if you're taxed as a partnership, you can change and elect to be taxed as an S corporation, and if you meet the qualifications and all that. But or if you decide to set up a new business venture, always talk to an attorney or a CPA. There's a lot of different things that can come into play with the differences in the entity structures, and like debt is one thing that's a major difference between partnerships and S corporations. How the debt is treated in an S corporation, to get basically to get the advantage of having the debt, you have to personally loan the business the money. If you take out just a loan, even if you co-sign on the loan individually, then you don't get the advantage of that being taken into account when they're allowing losses that you can take. Whereas in a partnership, as long as you guarantee that loan through the business, you can get that advantage of that debt being considered when you consider for taxes what losses you can claim on your tax return. So there's lots of other things like that that are affected by the entity structure you choose. So talk to your attorneys and CPAs and bankers, and just be open with them and tell them exactly what you want to do and what your goals are, and then that way they can be sure and give you the advice that you need and know that you're on the same page. So there's different rules like we were talking about for the basis calculation, which basically you have to have basis in the S corporation or the partnership to be able to deduct the losses from that. And so there's differences with the way loans are handled. It affects the basis differently. And other than that, it's very similar between the two. The main differences are the flexibility you have with how to do distributions and that sort of thing. With a partnership or an LLC, taxed as a partnership, you can, even if I'm 50% owner with somebody else, we can decide that, hey, any of the profits are going to be split 30-70. So you can really do whatever you want with a partnership or an LLC. But with an S-corp, everybody has to be treated equally based on their ownership percentage. So all the income expenses have to be split up based on ownership percentage. All the distributions have to be made based on ownership percentage. So those are the main differences. Other than that, the way the income flows through and is taxed on your individual return is the same. So objectives show you how to build a successful relationship with your banker and how to maintain the relationship. Why you need a banking relationship? Of course, checking account, borrowing. It's good to have a relationship set up. Makes it easier to go and get a loan if they already know you and have worked with you. And then, of course, other bank services, payroll and cash management. There's lots of ways that that bankers can help you with all aspects of your business. So it's good to talk to them and just tell them what you're wanting to do, what you need help with, and there's probably some way that they can help you out. So your goal is to leverage your equity to achieve a high rate of return on your investment, and bankers can help you do that. They can, with loans and different things, help you get all you can out of your investment in the company. And the bank's goal is to earn satisfactory return for the bank while minimizing their risk. So, that's what they're always looking at, the risk involved in, issuing loans and weighing that against what their return is going to be. So, bridging the gap between your return and the bank's safety, satisfactory loan proposal showing you can repay the loan, and your willingness to accept a loan structure that assures the bank of your ability to repay. Basically, that's what the bankers are looking at. They're wanting to make sure that if they issue you a loan, that they have to feel comfortable that you're going to be able to repay that loan. And that may mean you have to accept certain loan covenants, loan structure that they need you to accept to be able to issue that loan. That may mean keeping a certain amount in the company instead of taking it out for yourself, that sort of thing. Reasons for borrowing, of course, long-term sales growth, short-term sales growth, inventory expansion. So, if you need inventory, but you don't have the cash to go out and buy it right now, get a loan to get the inventory and then pay it back after you sell it. Receivables slow down, so maybe you have a lot of people that owe you money and you can't get them to pay, and then you need to get some cash to be able to keep your business going. Of course, capital expenditures, that's probably the thing most people think about is loans for vehicles or equipment, or buildings, that sort of thing. Cash flow timing difference kind of goes in line with the receivables, but basically you're doing business and making money, but just the way the timing of when the cash comes in and goes out, you just need some help there. And then unexpected events, accidents and weather, maybe something comes along and destroys your building and vehicles that you have in your yard or what have you, and of course you're probably going to need some help to get back up and running. So one thing I did want to touch on with the banking, a lot of times we see people when they have a business and they have it set up, as an SCorp or partnership or LLC, you got to have a separate bank account for that business. And a lot of times people, when they're the sole owner, or it's just them and their spouse or them and their brother or sister or what have you, they think, well, it's our money, and so they just use the business checking account as their own, which causes problems. So you've got to really keep them separate, and don't go to Sam's and use the company credit card to buy all your groceries for the month. Well, I don't really have any experience working with anybody that's gone to a factoring company, but I do know that it's fairly expensive. I think it's one of those situations where you just have to, as a business, be sure who you're doing business with. Make sure don't let people get to where they owe you a lot of money. And if you're doing work for somebody and it's substantial amounts of money, check them out first. Get financial statements from them. Basically, you're basically the bank at that time. Look at them just like if you were going to loan them money, write them a check for the money. Because if you do the work and they don't pay you, then it's the same as you just writing a check for that money and being out. I think that and just staying on top of it and watching those and if it's been a month, send them a letter. Don't let it get 6 months down the road and they still owe you money and you haven't checked back in with them. Decrease in liabilities, pay trade debt or pay bank debt, and then decrease in equity. If you pay a dividend or have distributions from an SCorp or partnership, that's going to decrease your equity. Or if you're buying out other owners, that could decrease your equity. Bankers' loan decision process, this is just kind of what they're looking at, what they're thinking as they're deciding whether they're going to loan you money for something. Look at the purpose of the loan. Is it legal? Is it ethical? And does it comply with their policies at their bank with what they will loan money for and amounts they'll loan. Repayment analysis, and I think this is the main hurdle. Is they always look at cash flow. It doesn't matter what income you show on your financials. They're going to look at the cash flow and make sure that you have the cash to pay them back. And then they're also going to look at collateral. If you're buying a vehicle or a building or anything like that, of course it's going to be collateral. They may also ask for receivables to be collateral or some other asset that you have. And then there's also guarantees where you personally guarantee the loan. So if the business can't pay it back, then you've guaranteed it. So you individually would be liable to pay back that loan. The structure, pay in full, pay on time, and pay as agreed. And you can structure loans a lot of different ways. So you can work with the banker, and it can be something where the interest accrues for the life of the loan, and you just pay back the lump sum at the end, the amount you borrowed plus the accrued interest, so you don't have to make payments over several months. So if you say you have a big project that you're going to be working on, and it's going to take a couple years, maybe you can agree that you don't have to pay every month. You'll pay the full amount at the end after you've completed that job, and have that money. And the pay on time and pay as agreed, I think are pretty much the same. I don't know what the difference is between those two, but there's lots of ways that they can structure loans. So just talk to your banker and tell them what your needs are, and they can probably figure out a way to help you out and make it work. A loan request, you're going to specify the amount and what it's going to be used for, the purpose, if it's going to be working capital or equipment or something else, the type of facility, a loan or a line of credit. The difference there being a loan is basically a set amount that you take out and usually make periodic payments back on that, and where a line of credit is just something you have set up where you have that amount available. You can borrow at any time, up to that limit on the line of credit. So there's different banks have different philosophies and kind of target clients, and it's building that relationship and that trust, because their whole thing is they want to limit the risk. So if they've worked with you before and you've always paid on time and that sort of thing, then you're likely to get a lower interest rate than if you just come in off the street and your financials are in disarray, and you may be even lucky to get a loan because they're looking at the risk and how much they can trust that you're going to be able to pay that back. And I've had bankers that we work with, they say, if there's certain accounting firms that if I get financials from them, then they're like, okay, yeah, they're good. And there's other ones that if I get financials from them, then I can basically throw them in the trash. They know which ones they can trust and which ones it's just somebody taking numbers and throwing them on a piece of paper. And so there's talk to your bankers and ask them stuff like that. Say, is there somebody else you think I should be using, or are there different? Yeah, and it's one thing that I think a lot of times people, especially when they're starting out, they don't keep up with the accounting side of it as much as they should. They just look, if they have money in the bank, then that's all they care about. But then once they go and start trying to get loans, and if they're doing other things that people are wanting to see financial statements, and it can be a huge mess to try to clean that up and get it in order. And then you're just paying an accountant more to try to clean it all up than if you keep it in good shape from the start. So there's very few that run the business and do the accounting themselves that do a good job, because when things get hectic, that's the first thing they put aside. And then when you're going back trying to figure out what happened 6 months ago, it's just, you can't do it. So all that kind of stuff plays into your obtaining financing, and how comfortable your banker is going to be loaning you money. So and then of course I think it talks about this somewhere, but I'll touch on On the guarantees, if you're personally guaranteeing the loan, then you're also going to need personal financial statements. So that's another thing to consider. And let's see, credit analysis. They're going to look at your line of business, the ownership and management. You know, how much experience and education and training you have, percentage of ownership, you know, who owns the majority of the business, and you know, who's really running things. You know, if there's a board of directors, who's on the board, what experience they have, what knowledge they have, that sort of thing. Track record, how long you've been in the business, you know, successes that you've had, failures, you know, what customers you work with, are they reliable? Are they, you know, if you have, you know, half of your business comes from one customer, you know, it's pretty important to know whether that business is going to be around when they decide to loan you money. Suppliers, are they reliable? What kind of competition you have? Are you going to be able to compete if there's, you know, a downturn in the economy? Or are you going to be, you know, the first one that's going out of business? And of course, industry conditions and trends, kind of all that plays into their analysis. Financial statement quality, kind of what we were talking about just a minute ago. Are your financial statements audited or unaudited? And then if they are audited, is a CPA firm experienced in the construction accounting? And even, you know, I've had clients that come to us that worked with firms that claim to be, you know, construction experts, and, you know, barely had a clue what they were doing. So, you know, it all depends on the quality of the CPA firm, on what kind of financials that you're going to get. There's also, you might also hear compiled financials and reviewed financials. Compiled financials is basically where the CPA firm takes all your transactions and records them and basically does the accounting for you. So they'll take your check register, bank statements, and all that, and record all the transactions, you know, the way they need to be recorded. And then there's reviewed financials, where either somebody has compiled the financials, or you just bring them the financials that you've prepared, and they look over everything, analyze it, but it's not nearly to the degree of audited financials. But it gives bankers, you know, some degree of certainty that, you know, somebody has looked over this, they've asked some questions, you know, they feel comfortable that it's, you know, in pretty good shape. But you know, and of course the audit is, you know, the all-out checking everything and doing all the tests, and yeah, it's a lot more expensive. But sometimes, you know, depending on how big you are and how much money they're going to loan you, they may require you to have audited financials, and you know, depending on who you work with, other you know, contractors or what have you may require you to have audited financial statements, or some of them just require a review. So there's several different levels, and kind of the audit's the most expensive, then review, compile financials, a little bit less expensive. A lot of times, what you'll see is companies, like a lot of times what we do is we work mostly with the clients and we compile the financial statements, but since we compile them, we're not allowed to do the review. It has to be an independent, because we're not considered independent at that time, because we are recording the transactions for the client. So we'll compile them, and we're the ones that work with the client, but then we send it to another CPA firm who reviews the work that we've done, and so they can sign the review report. And they're going to look at completeness, the balance sheet, income statement, cash flow statement. Those are the three main ones. And a lot of times the bankers are looking more at the balance sheet and the cash flow statement than they are the income statement, because there's a lot of things that can affect income that don't necessarily affect the cash flow as much. So, and that's the main concern that the bankers have, is the cash flow, making sure that you have the cash to be able to pay them. And then receivables aging, payables aging, how long does it take you to collect your receivables, and how long does it take you to pay your payables? Those are things they're going to look at. Make sure that if you're taking a long time to pay your payables, then you're probably going to be taking a long time to pay the bank back too. And then contract status report. And I'm not. You guys may be more familiar with that than me, but probably just looking at the status of the contracts and dive into a little more detail on financial analysis, the internal trends in comparison with industry statistics. So they'll compare your business to other businesses of similar size in the same industry, to see, even though you may be profitable, it may be less than or more than, comparable companies in the same industry. So there's lots of services out there that kind of track those things, and they can compare your business to other businesses and look at profitability and liquidity, leverage and solvency. All those are, well, the last three are all balance sheet trends, and looking at how much cash you have and compared to your debt, and if you need to sell off to pay the loan, how easy is it going to be for you to sell your assets and to be able to generate some cash. Cash flow, they'll look at historic cash flow, what it's been in the past, and then they'll do projections. They're going to project most likely what it will be going forward, and then maybe look at the downside, if things don't grow as fast as they have been, if there's a slowdown, or if you have to pay some higher interest rates or something like that, kind of take those into effect and see if you're still going to be able to pay those loans if things aren't going perfect. Collateral, kind of touched on this earlier. They may ask you to put some of your receivables up as collateral. Fixed assets, usually that's if you're getting a loan to purchase a fixed asset, the fixed asset's almost always going to be the collateral, but you may own fixed assets already that they ask you to put up as collateral on a new loan that's not being used to purchase that asset. And guarantees, this is where they're going to need personal financial statements. And they must show joint owners of any personal assets. So, they're only going to consider, your share of ownership in assets. So, if you and your spouse own something together, or, if your family has a lake house together or something like that, then they're only going to consider, your share of those, the ownership in those. And, something with a lake house, if you own it with, if you have two siblings that you own it with, well, they may not consider that because, what are the chances that you're going to be able to convince your siblings to sell that house and get the cash to pay off the loan? So they'll look at the adjusted net worth. So they'll deduct the investment in the company because they're already considering that on the company side as the value of the company. Deduct any assets hard to liquidate, kind of what I was getting to with the lake house example. If you have things that are just going to be hard to sell, then it's not going to be easy for them to get their money. And then they'll consider if there's any liabilities not on the personal financial statements. So maybe if you have, a lawsuit against you or something like that, can take that into consideration. This kind of gets down to, just having a relationship with them and, explaining everything to them and being open and honest. Translate the reason you're borrowing that specific amount, what the purpose is, what you're going to use it for. Be able to show you can repay the loan in that time frame, and be willing to guarantee the loan. If you're not willing to guarantee, then that shows them that you're not as sure as you need to be that you're going to be able to repay the loan. And of course, they're going to look at personal financial statements and tax returns. So if you're behind on filing your tax returns, you have to get those caught up, and then be willing to collateralize, put up some assets as collateral, and help the banker get the information he needs, which maybe talking to your accountant or other people that you may work with, attorneys or what have you. And you've got to just be able to be completely open with them, and if they feel like you're trying to hold something back or hide something from them, then that's not going to be a risk they're willing to take. And it may be something that you think is a big deal and you don't want to tell them about, but you got to tell them, and sometimes it may be something that isn't a big deal to them. So, or they can figure out a way to work around it. So, and then they may ask questions to your suppliers or customers, bonding company, lenders, competitors, accountant, lawyer. So let those people know that, you know, you're going to be borrowing money, and the bank may be calling them, and just let them know what's going on so they can provide the information that the bank is requesting. Then check your personal credit report. You know, make sure there's nothing on there that is inaccurate. Get all that kind of stuff cleared up before you go to the bank, and it'll help speed things along and cut out a lot of work. Build your professional support team. You know, work with lawyers that are experienced in construction or real estate law, and try to enlist a couple outside directors. If you have directors in your, like a board of directors, lawyers, accountants, engineers, just people with different experiences, different knowledge, is going to help you make better decisions and you know, lead your company in the right direction. Of course, keep in touch with your banker. We've talked about this, and you know, just you know, it's about building that relationship and keeping them informed of what's going on in your business, whether it's good or bad. And you know, they know a lot of people, and so they're only making money if you're making money and you're able to grow your business. So they're gonna do everything they can to help you out. Because if you're not around, then you know, they can't loan you money and make money themselves. So summary, you know, just work on building that relationship, and you know, be open and give them all the information they need. Work on getting it to them as quick as you can, and you know, show that you're willing to back up your request by making guarantees or providing collateral. Maintaining a relationship means giving the banker access to you, your company, and your jobs. You know, they may even want to come out, tour your business, you know, see some of your the jobs you're working on, just so they can have a better idea of who you are and what you do. It's a lot different seeing what somebody's put down on paper than go out and actually look at it. And like I said, just keep them up to date on good news and bad news. So, well, that's all the slides we had. Does anybody have any other questions about banking, or going back to the entity structure, or just any other general accounting questions or business questions?